Mackenzie Smith, staff writer at Risk Magazine. I'm interviewing Naveen Kunam at Allianz Global Investors. Thank you, Naveen, for taking some time. We want to talk today about the next Federal Reserve rate hike. Many predict it's going to come in September or December this year. Want to get your views on what the likely impact is going to be.
The rate hike has been well advertised for over since 2013 onwards. So we have had enough awareness among global investors, be it particularly for emerging market investors. So whenever it comes, it won't be a surprise. That's number one. And as Fed has been communicating to the markets, the rate hikes will be very gradual. So we don't know what that precisely means. But in my mind, maybe it means that we're not going to see 25 basis points rate hikes. We'll probably see 12 basis points rate hikes, or maybe, and we probably don't see rate hike every meeting. We probably have a rate hike every quarter. So at this pace, to get to 2%, it will probably be 2 years. So this, in my mind, given where we are right now, in terms of valuations across emerging market currencies, there are some currencies that still need adjustments, but there has been enough risk premiums built into most of the currencies. So if the Fed hike is supposedly the way it's supposed to be, meaning in the sense it will be gradual, then I don't see any risk of any crisis in emerging markets.
Mm-hmm. The sort of phrase risk on, risk off has been used quite a lot in emerging markets. And I think many people have been saying to me that in the last sort of 6 months or so that's changed, and that there are particular emerging market currencies which are reacting differently to others. Would you agree with that? And do you think based on that they'll be differently affected when the Fed does eventually raise rates?
Yeah, the risk on, risk off, there's just too many factors, I would say. If you look at European currencies, right? European currencies, European assets in general, like be it equities and spreads, they're rallying when euro is depreciating, because as a policy, euro depreciation is quite good for euro area as a whole, and subsequently for the CEE area as well. So even though currencies are depreciating, but their assets are rallying, be it equities, credit spreads, and even bonds, because the policy is quite easy, and so we will have we'll have ECB in a quantitative easing mode for a longer period of time. So that's on the contrary. When euro is selling off, which is good for most of the euro area assets, it's not so good for other currencies, because euro as a region is gaining competitiveness because of a cheaper currency over Asia, over Latin America, even though they don't necessarily directly compete. But at the end of the day, euro depreciation will impact Asian currencies, because most of the Asian currencies, they trade with euro. And so by definition, it will impact their trade balances. So they will have a beta of anywhere between 0.3 to 0.6, which means, if euro depreciates 1%, a currency like Malaysian ringgit would depreciate 0.5%, and so the ones that are decoupled from this risk on risk at the moment, risk on risk off mode, is India and China. Because largely China is keeping its currency stable, because China at the moment is witnessing a lot of capital outflows, and also we all know what happened to the A-shares market. So there's been a lot of concern around Chinese equity market. So at this juncture, the last thing that China wants is to have a currency volatility. So they are vehemently keeping the currency vol in check. So if you look at it, even though the CNY spot is trading at 620, while the fixing is 611, so that's about 1.5% above the fixing, so which is the band. So the currency is already at the upper end of the band, but then PBOC keeps fixing it at the lows, because as a policy, it wants to keep that currency for a couple of reasons. China wants to have RMB to be included in the SDR, so that's why they want to keep a stable currency, and also they don't want to risk financial instability, so to introduce currency volatility. The same applies to India, even though India is not really is fixing like China is doing, but India is intervening on both sides. When currency is selling off, they are coming out and selling dollars, and doing the other way when currency is rallying, when they're accumulating dollars. But both of them have fundamentally positive headwinds now in the sense because of the commodity prices, the oil prices, both of them big importers of oil and every other commodity out there. So commodity prices where they are is very positive for both China and India as a domestic consumers.
Thoughts on liquidity? That's been a big topic this year. People have been saying to me that, particularly in NDF currencies, that it's been a lot harder to get out of positions. Is that a concern for you, particularly when there is a rate hike? How easy it will be for investors to get away from emerging markets if they want to?
Yeah, I mean, yes, the liquidity is no longer two-way like it used to be. Again, this is because the players in the market are much different now than they used to be. Let's say 5 years ago, pre-crisis or just around the time. So you got several, institutional investors, you got hedge funds. I meant mutual funds and hedge funds. And you have crossover investors, which are not dedicated to EM, but they are, investors in Europe and US, but they were substantially allocating capital to emerging markets. So at the moment, over the past 2-3 years, because of the policies in developed markets, primarily US and Eurozone, so there has been a lot of interest in buying their own assets. So like in the case of Europe, people are buying their own peripheral debt, people are buying European equities, and the same is happening in the US, happened and has been happening. So that's why the crossover investor is absent to the emerging markets. So that removes the that was the big missing element at this point. So, but the dedicated investor, the asset class is not witnessing inflows. So, which means as a whole, there is not new amount of capital being allocated to emerging markets. So that leaves them in a bind in the sense they have to be long, but then if you want to get out, there's not much liquidity. There's no one who is taking the other side, mainly because banks are not risking any capital at the moment. They're only acting as an intermediary, so which means they're not taking any prop positions. So that's making it very complicated.
Okay, thank you very much.